In the official reports, the economy of the United States still appears strong. The number of people without jobs stays low. The earnings of companies have not fallen down. The stock market continues to stay near very high levels. And yet, if you talk to normal citizens, especially families with middle incomes, you hear the same thing many times. Life feels more difficult than it should. Buying food feels like a bigger burden. Paying rent feels harder to justify. The debt on credit cards stays for a longer time than people expected. Even people who received a pay increase over the last few years do not feel like they are truly moving forward. That gap is not an accident, and it is not only because of unwise spending. The true story exists quietly out of sight inside the way families handle money. The costs of interest have stayed high for much longer than most people thought they would. Debt that grew during the years of cheap money is now being paid back at much higher costs. And while pay did go up, it did not go up fast enough or in a fair enough way to handle that change. This is not a sudden crash. It is a slow squeeze. More income is already promised to others the second a paycheck arrives. Less money is left for other choices. Less can be put into savings. And for millions of families, the room for making a mistake has quietly vanished. In this video, we are not looking for scary news or yelling that the whole system is going to break. When people say that citizens are struggling because they spend too much, they usually imagine extra choices, too many monthly services, eating out too much, or buying things without thinking. But the most important pressure point in the money of a family right now has very little to do with how they live. It has to do with interest. By the end of the year 2025, the payments for personal interest in the United States were moving towards $600 billion on a yearly basis. That number by itself does not mean families are failing. But it tells us something very important. A growing part of income is being used just to keep up with old debt, not to buy new things, not to improve how people live, but simply to stay current. A more exact way to see this pressure is through the ratio of family debt service, which has stayed a little above 11%. In the past, that is not a scary level. What makes this time different is how long that weight has stayed heavy. At the same time, other costs like housing, insurance, power, and daily needs also stayed high. Even though interest rates have dropped from their highest point, the help has not fully reached the people. Many credit card totals are being carried at interest rates higher than 20%. Loans for cars taken out over the last few years fixed expensive monthly payments in place. People who own homes and changed their loans when money was cheap are doing fine. But anyone who did not is now facing much higher costs to pay for their home with little chance to change the terms. This is why financial stress can grow even without a normal period of economic decline. Families are not necessarily failing all at once. Instead, the ability to be flexible is going away. When more of your paycheck is already promised to interest, there is less room to handle surprises, less ability to save, and less power to change when prices move again. In other words, this is not about unwise buying. It is about a financial system that quietly changed the cost of daily life and left many families carrying the debt of yesterday at the prices of today. At first look, data about pay seems to go against the idea that families are under pressure. The average pay per hour in the United States is now just under $37 an hour. Compared to the levels before the pandemic, that is a big increase. On paper, workers are making more than they did just a few years ago. The problem is not that pay failed to go up. The problem is how that money works with everything else. The growth of pay is measured in name only. It tells us what people make, not how much those dollars can actually buy. Over the same time that paychecks grew, families had to deal with many types of cost pressure at the same time. Rents went up, insurance costs grew, the cost of borrowing money jumped, and daily needs stayed at high price levels that never fully went back down. As a result, a larger part of income is now spoken for before a family even makes a choice about extra spending. The paycheck arrives already given to rent or a home loan, to insurance, to the smallest debt payments, and to utilities that no longer change the way they used to. What is left after those fixed costs is what decides the amount of breathing room, and that part has become smaller. This is why so many people say they feel worse even though they make more money. It is not in their heads, it is simple math. When fixed costs rise faster than the money you can actually control, the feeling of struggle becomes a part of the structure. This change helps explain why the cost of living in America feels separated from the strong news about the economy. The economy can grow, the number of jobless people can stay low, and pay can go up, Yet families can still feel trapped if the basic costs get tighter faster than earnings can pay for them. In that setting, financial stress does not show up as everyone failing to pay at once. It shows up as waiting, putting off decisions, having fewer safety nets, and a constant feeling that one surprise cost could break everything. A few years ago, the idea that a single person would need almost $100,000 just to live well sounded like a lie. Today, it is increasingly proven by facts. As of 2025, new studies on the cost of living show that a single adult in many large cities in the United States needs at least $80,000 just to meet a basic definition of comfort. And in the most expensive cities, the number goes much higher. In places like San Jose, the limit goes well past $140,000. In New York City, it sits around $130,000. It is important to be clear about what comfortable actually means in these studies because it is not about having a rich life. It does not mean expensive trips, fancy cars, or big spending. It is based on a simple plan. About half of the money goes to needs, 30% goes to extra spending, and 20% is put away for savings and safety for the future. What has changed is not the meaning, it is the math. Housing by itself now takes a much larger part of income than it did 10 years ago, especially for people who rent and people who just bought a home. Insurance for health, cars, and homes has become a constant weight. And when you add in higher interest costs on old debt, the part of income meant for savings quietly goes away. This creates a small but strong change in how people feel about their money. Someone making $70,000 or $80,000 may no longer feel like they are in the middle class in the way that income used to mean. Not because they want more things, but because the basic cost of being safe has moved. The result is a growing gap between the name of an income level and the real life of a person. Families that look strong on paper feel like they are always falling behind. They are not breaking apart, but they are not moving forward either. And when the idea of doing fine moves up faster than pay can follow, financial stress becomes normal. It stops looking like a sudden problem and starts feeling like the regular way of life. One of the clear signs of this money squeeze does not show up in charts about spending or data about pay. It shows up in savings. By the end of 2025, the rate of personal savings in the United States was sitting around 4%. That is not a level that means a disaster is happening, but it is very low for history. It is well below the levels families reached for a short time during the pandemic, and it sits near the low end of what experts think is a healthy amount for the long term. This matters more than it might seem. Savings are what handle a shock. They are what turn a surprise cost into a small problem instead of a huge emergency. When savings are low, even small problems have very big results. A bill from a doctor, a car that needs fixing, or a short time without a job. None of these need a crash in the economy to cause harm if there is no safety net under them. What is different in this time is that savings did not go down because families suddenly became careless. They fell because many families were forced to spend their extra money just to stay safe. Higher rent, higher insurance costs, and higher costs to pay for debt quietly took the money that would have gone into savings during normal times. Once those safety nets are gone, how people act changes. People wait to fix things. They wait to move to a new place. They use credit more, not because they want to, but because they no longer have any extra room in the system. This is why economic stress today feels like a constant weight instead of a big explosion. There is not one big breaking point. Instead, families are living with smaller margins where every choice is more important than it used to be. And when millions of people are living without real savings, the economy becomes more weak, even if the main numbers still look good. If there is one place where financial stress shows up clearly, it is in the data about being late on payments. Not the news, not surveys about feelings, just the simple question of whether people are failing to pay their bills. As of late 2025, the rates for being late on credit cards in the United States sit just under 3%. Loans for people are late at a rate around the high end of 2%. Those numbers are not blowing up. They are not showing a red alert, and that is exactly why they are important. In past times of trouble, late payments went up very fast and very high. That is not what we are seeing now. Instead, they rose from very low levels and then stopped growing, staying at a higher level than what was normal before the pandemic. The pattern is not about fear, it is about things staying high. This pattern tells us something big about the current world. Most families are still finding a way to pay what they owe. They are making those payments first. They are changing how they spend. They are doing what they can to avoid falling behind, but they are doing it with less room for a mistake than before. Being late on payments usually happens after the stress has already started, not before. By the time they go up high, the harm is already done. A flat but high rate of late payments suggests families are being pushed to the limit, but still staying together. It is like a machine running at full power without a brake. This is where the idea of a debt crisis for families in the United States becomes more complex than the news says. It is not about everyone failing at once or a sudden crash. It is about a system where debt is okay until it is not, because the safety nets are already gone. When financial pressure grows this way, it does not make a loud noise. It shows up slowly in waiting to buy things, in using credit that rolls over, and in being very sensitive to any more cost increases. And that is what makes this part of the time easy to value too low and dangerous to ignore. The option to buy now and pay later has become an easy target when people talk about the money of consumers. It is often described as proof that Americans are living beyond what they can afford, paying for everything from clothes to food because they do not have the money right now. The truth is more complex. Data from the government shows that using this option grew fast between 2019 and 2023, and it has stayed a common choice through 2025. But this option did not create the financial stress. It answered it. For many families, this is less about buying treats and more about managing when money comes in. When savings are low and fixed costs are high, spreading out payments becomes a way to handle the ups and downs of money, not necessarily to spend more. It changes when the pain is felt, not if it exists. That is why this payment choice often happens at the same time as other kinds of debt. People using these services are more likely to carry a balance on their credit cards and handle many payments at once. This does not mean they are not careful. It means they are moving through a system with fewer safety nets and tighter limits. In that way, these plans do the same job that older payment plans did in other times when money was tight. It allows people to keep buying things even as things become harder to afford. The danger is not the tool itself. It is what happens when too many tools are used at the same time. This works until it does not. Missing a payment, having too many bills, and late fees can quietly turn a short time of flexibility into a long time of struggle. Not in one night, but slowly. And that slow growth is the main idea of this entire time. Fewer safety nets, more use of credit, and a money system that asks families to handle a difficult world that did not exist 10 years ago. For a few years, loans for school quietly went away from the view of family money. Payments were stopped. Interest was not added. And for millions of people, a big monthly bill simply went away. That stop is now over, and its return matters more than many people thought it would. As payments started again, these bills came back into the budgets of families at a time when other costs were already high. For young workers and people with middle incomes, this brought back a fixed cost just as rent, insurance, and interest were taking more of their money. What makes these loans especially strong is the group of people who have them. These people are often in the early or middle parts of their work lives. Their pay has gone up, but so have the costs of living. Many are also dealing with credit cards, car loans, and housing costs at the same time. School loans do not come by themselves. They sit on top of everything else. This helps explain why financial pressure feels strongest in groups that should be doing okay according to the numbers. These families are not in trouble because of one bad choice. They are handling many long-term bills that were made for a very different kind of economy. Unlike other kinds of debt, school loans do not change easily. There is not much room for choice. Payments are easy to predict, but you cannot avoid them. And when they come back after a long stop, they take away cash right away, even if the total income has not changed. The return of school loans did not start a crisis, but it took away one of the few ways families had to get temporary relief. And in an economy already working with very little extra room, losing that help makes the whole system feel tighter faster than many people expected. Housing is where the money pressure is easiest to see and most confusing. Prices have not crashed. Rents have not fallen. Yet, for many families, the numbers simply do not work anymore. The gap is not just about the main prices. It is about the math of how you pay for it. In many cities in the United States, the monthly cost to own a home, including the loan, taxes, insurance, and fixing things remains much higher than renting a similar place. Even where the prices of homes have stopped moving, higher interest rates have changed what people can afford. A home that looked okay at one interest rate becomes a totally different thing at another rate. This change has changed how buyers act without starting a normal crash. People who want to buy are not jumping in when prices drop a little. They are stopping, looking at the math, and deciding that renting is the safer choice for now, even if it is annoying. At the same time, people selling homes are stuck on the prices of the past. Many bought or changed their loans when money was cheap, and they do not want to lower their price. The result is a market that feels like it is not moving rather than one that is broken. Not many sales are happening, homes stay on the list for a long time, and prices move slowly instead of falling fast. This is why housing stress today feels small and quiet. There is no sudden fall. Instead, there is a growing gap between what homes cost and what families can realistically pay for without giving up their safety. For people who rent, that gap shows up as high costs that stay high with no relief. For buyers, it shows up as waiting and trying to avoid a mistake. And for the whole economy, it means housing no longer helps people move up the way it once did. Housing has not fallen down, but it is no longer an easy way to get ahead. And when the biggest cost in the budget of a family stops working the way people think it should, the pressure goes far beyond houses and buildings. If family money is under quiet pressure, the world of business buildings is where that pressure is easier to see for the financial system. Buildings for offices, hotels, and some stores were paid for with ideas that are no longer true. The way people use these buildings changed. The need for them did not fully come back. And paying for them again is now happening at interest rates that are much higher than what the owners thought would happen a few years ago. The result is not a sudden crash, it is a slow burn. People failing to pay are appearing in some places, but not everywhere at once. Buildings with low money coming in or too much debt are the first to feel it, while stronger buildings keep working. This uneven stress makes the problem easy to think is small. What matters is where these loans are held. A large part of the debt for business buildings is held in small and medium banks. These banks do not have the same safety nets or different kinds of money as the biggest banks. When these loans do not do well, the stress does not just hit the owners of the buildings. It makes it harder for everyone in those towns to get credit. This is why the people who make rules have called business buildings a weak spot rather than a crisis that is about to happen. The system is not breaking, but it is taking in pressure over time. Losses grow quietly. The rules to get a loan get tighter slowly, and the risk moves around instead of exploding. The danger in a slow risk is that people think everything is fine. Because there is no big moment, the problem can stay for a long time and spread further than people think. Families feel it in a way they cannot see through having less credit, higher costs to borrow money, and fewer chances to change their loans or grow. Stress in business buildings does not need to cause many banks to fail to be important. It only needs to slow down the movement of money in an economy that is already working with very little extra room. And in a world like this, even small shocks can have very large results. As financial pressure grows slowly instead of falling all at once, the people who make the rules are caught in a bad spot. There are no easy answers left, only choices that move the pain from one group to another. If they lower interest rates too fast, borrowing becomes cheaper for a short time, but the risk of prices going up starts again, taking away the power to buy things all over again. If they keep rates higher for longer, families already pushed by debt and fixed costs feel the squeeze get worse. If they step in with help or emergency money, the system avoids failing right now, but at the cost of more debt in the long term and the danger of people taking too many risks. What makes this time especially hard is that the economy is in a strange middle place. It is not weak enough to make a big change in rules, okay? Yet many families are not strong enough to handle financial pressure that stays for a long time. As a result, the rules have been about buying more time instead of fixing the deep problems. And that difference is important. Buying time can make markets stay steady, but it does not put money back into savings. It does not lower the basic cost of being safe. And it does not change the shift that has pushed more family money toward interest, housing, and other bills that must be paid. This is why the financial strain of today does not look like the problems of the past. The debt crisis of the family in the United States is not defined by everyone failing at once or a sudden crash. It is defined by a squeeze, having less room to move, thinner safety nets, and fewer choices when something goes wrong. And over time, that squeeze changes the cost of living in America. Not through having too much or living in luxury, but through the basic price of staying above water. The real question is not if the economy can keep growing. It is if families can get some breathing room before the next surprise arrives. If this explanation helped make clear what is really happening under the news, Subscribe so you are not moving through the next time without seeing where you are going.